Today, we're going to be talking about potential opportunities and potential risks when it comes to investing in private markets. We're going to discuss what private markets are compared to public markets, and then how to consider getting a higher potential rate of return, and what are some of the dangers that come along with it. So let's get started. When we're talking about the private markets, what exactly are we discussing? Well, we're probably pretty familiar with the public markets. So when you think about these primary asset classes of publicly traded stocks, publicly traded bonds, or publicly traded real estate, or maybe like a REIT, people are pretty familiar with investing in the publicly traded market. You can log on, you can look something up and see to the minute typically what people are willing to buy and sell these investments or these assets for. Well, in the private markets, it is typically similar assets, but not publicly traded. And so you can't just go online and see what an asset is buying or trading for, but you still have those same three primary asset classes of stocks. So you can buy equity in a private company, or bonds, you can buy credit or issue loans to a privately traded company, or real estate. So instead of buying a publicly traded REIT, you can go buy REITs privately or go buy real estate privately. And so think about those three asset classes and the ability to own them privately or own them publicly. Now, you probably have not done much private investing in the past. Why is that? Well, it's because it hasn't really been an option. So typically, private market investing has been available to institutions, endowments, or those with large amounts of money to invest. So it's been relatively restrictive. It's going to be becoming more available to investors that didn't have access before due to technology and general access, which is potentially good, but it also means we need to know what we're doing. And so we're going to talk about what some of these dangers are. So let's dig in and just look at, for example, well, how big are the private markets from an investment standpoint? Well, this chart here looks at equities or stocks. It compares the private markets to the public markets. Now, this chart is looking at companies that have annual revenue over $100 million. So pretty good sized companies. Well, when you look and you compare private companies to public companies, 92% of companies are private that have revenue over $100 million. Only 8% of companies are publicly traded that have revenues over $100 million. So what's another way of saying that? Another way of saying that is the private markets offer the potential to further diversify the portfolio, because in the public stock market, that's only 8% of the companies that we can invest in. And so, okay, that's private equity. The story remains the same when you're looking at private credit, private real estate. There are opportunities to further diversify by looking at assets that are not actively traded. And so we say, okay, well, does this help us for our returns? How does that look? Well, this chart here is going to compare public markets and private markets. Going from left to right, that's the volatility line. So further to the left means less volatile, more to the right means more volatile. And on the y-axis, or the vertical line, is your rate of return. So lower is a lower rate of return, higher is a higher rate of return. So the goal would be, well, hey, I'd love less volatility and more returns, which is up and to the left. And as we look at the public markets, what you see is over to the right, you've got your US stocks, you've got your public REITs, which is public real estate. And you've got over back to the left, you've got your US investment grade bonds. And that's typically what people are talking about when they say publicly traded bonds. And then you have a few other asset classes in here. And when you say, okay, well, this is the publicly traded assets, where are the private investments? Where's private equity? Where's private credit? Where's private real estate? Well, as we look at where these other private markets land, what we can see is the rate of return is higher. The volatility is actually sometimes lower. Now, we're going to talk about return, but for a moment, I want to talk about volatility. Because typically, if you're going to accept a higher rate of return, you anticipate higher volatility. Now, with these private assets, they are plenty volatile. They're just not traded every day. So you don't have millions of people buying and selling them every day, so you just don't see the change in assets. It's kind of like your home. Think of it that way. Your home is probably changing in value all the time, but you don't have somebody giving you an active offer every moment. So it doesn't feel as volatile. So private markets, on paper, they will say it's less volatile. Is it really? I would say probably not. It's just not priced as often as the public markets. But you'll see the return is higher. So why is that? Why would a private investment give us a higher rate of return than the public asset? Well, if you think about it, with private assets, you are going to be tying your money up potentially for a longer period of time. You will not have access to those funds. And so in the market, this is called an illiquidity premium. So I expect a premium, or I expect a higher rate of return if you're going to tie up my money longer. You have to compensate me for tying up my money for an extended period of time. And so that's why you would expect a higher rate of return in the private markets than the public markets. Now keep in mind this does not always happen, but this is typically how it's worked over time, is you're anticipating certain premiums from different markets based on where everything is. Okay, well we've talked about, well, they're potentially less volatile. It seems like they have a higher rate of return. What is this danger that you talked about, Kyle? Well, what we're going to talk about. The biggest danger in private market investing is the manager that you select. Because in the public markets, whether you're choosing a good manager or a bad manager, if you're buying large cap companies, there's not a huge difference in returns. Let's look at this chart here and get a little more into that. So what you've got here in the public equity markets is the 25th percentile to the 75th percentile. In other words, the majority of managers fall in a very tight band around their returns. In other words, the best and the worst are not that far off. Okay? Now, how does that look in the private markets? Well, that same band gets much wider. And as you can see on the outliers, it gets even more extreme. But just looking at the majority of the time, your manager absolutely matters, and substantially more than it does in the public markets. Now, okay, that's equity. What about bonds or fixed income? And what about real estate? The story is the same. And so what you can see is in the bond and in the real estate versions that are publicly traded, the best managers and the worst managers trade much closer to each other versus when you're dealing with the private managers. There's a huge difference between the good private managers and the bad private managers. And so when you're looking at these types of investments and you're considering, hey, should I be adding private investments to my portfolio? It's incredibly important to understand who is going to be managing this money, because the manager matters. There's not a great index where you can just go buy all privately traded assets. And so if you're not sure, sometimes it makes sense to not do anything, because the public markets can still help you achieve your goals, but the private market options, whether it's technology and platforms that are changing, will become more available. It can be a good thing, but it comes with important risks that you need to make sure you understand. Warren Buffett, he said, in investing, the biggest risk is not knowing what you're doing. And so it's important to look at these markets and make sure, do I fully understand what I'm doing? Is my team informed? And do I have a clear picture of how this is going to help me achieve my long-term goals? Hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.